Okay, now that we've used the discounted dividends model of valuing stock, let's talk a little bit about some practical limits on using the dividend model. So first, it is really common for stocks not to pay dividends, and not in the sense that they will randomly choose not to pay one because they're in trouble, but in the sense that there are stocks that haven't paid dividends and likely won't pay for a very, very long time. So if I'm a company that does not pay dividends, then it's hard to use the discounted dividend model to find their value, because we would have to plan for dividends far into the future, which are then very, very subject to the interest rate we apply to the valuation. So a small change in expected return leads to a large change in the value of the stock. And so our valuations become very sensitive to assumptions that we don't necessarily have a ton of information about. So what is the appropriate required return on a stock? Well, we would claim that it is the required return that you would need given the risk of the stock. But the risk level of companies change all the time. So at one point, Google was a startup company that was very risky, and then they were a growing company, and then now they're a very solid, large company with very significant revenues. But at the same time, they have, now they've morphed into Alphabet and have all of these other projects that may or may not pan out. And so it's really hard to get a handle on really how risky Google is. And this is something that intelligent people can have pretty serious disagreements on. And so coming up with a firm valuation number for even a mature company is hard, because understanding what the risk level of a company itself is hard. On top of that, growth, we're talking about future growth, and future growth is by no means assured. So if you're Bayliner Boats, your growth rate might look a particular way, and then we go through a financial crisis and an economic recession, and now your growth rate looks very, very different. You have maybe a negative 90% growth rate in a year. These are the kind of events that are hard to put into a discounted dividend model, because they're just so huge and somewhat random. But even if we have no drastic, unusual events or lots of disagreement, we still need to maybe come up with a way to estimate these parameters given the data we have. And so in general, if we're thinking about growth, where does growth come from? Growth comes from investment. Right? If I invest, that money turns around and creates new business, which then grows the firm. And so if I am trying to figure out how much the firm is expected to grow, I should be able to look at the investments the firm makes and the returns that the firm typically gets on investments it makes. So we have a simple product here. So G, our G estimate, is the ratio of the money that is retained by the firm times the return on earnings that are retained. So if I retain 50% of the money that the firm earns, and I earn 8% on that money, right? If I retain all of it, then it makes sense that we just grow 8%, right? I every year, all of the earnings are invested, they get 8% back, so earnings would grow by 8%. But if I invest half, then we'd expect that half would earn 8%, and so compared to the whole, it's only 4%, right? By comparison, as half gets spent, half gets invested, that invested amount grows at 8%, so the overall growth is 4% once you include money that was distributed. And so that's a quick way to get an estimate of growth. Retention ratios aren't necessarily stable over time, and neither are returns and retained earnings, but it's at least a kind of systematic way to get at that. R, the return, where does that come from? So we've talked about comparing risk, find a similar risk company and look at its return. But we can also talk more fundamentally about where the returns come from. And in general, they come from a dividend yield, right? The return you get in actual cash from the stock itself. And then the growth rate. A higher growth rate would mean that the company would have better returns. And so we can, and actually R itself is the sum of those two things. So if I have a 4% dividend yield that's growing at 4%, we could add those and get an 8% overall return on that stock. But estimating the dividend yield is easy. If it actually pays dividends, it's very straightforward to find that. But the growth rate in dividends is hard. It depends on predicting the future for the firm, and that can be error-prone and challenging. So there's a great deal of estimation error in estimating R. We don't have a very good handle on the interest rate appropriate for stock in general. So if I use a dividend growth model to find the interest rate, we're actually doing what we've just done but backwards, right? So if I know the price, I can back out the implied growth rate. And doing a little algebra, you can actually solve for R and get dividend over price plus G. And that's where those two types of growth come from. We have, in the first place, dividend over price. That's the dividend yield. And in the second term, we have G, or the growth rate in dividends. And the return is the sum of those two, assuming the constant dividend growth model. Another way to think about this is the price of a stock is equal to the earnings. This is a more accounting-based approach. So we have the earnings of the firm as a perpetual stream, right? So if the firm earned earnings this period, assume if we do nothing, right? If we don't invest at all, then the firm would just earn its current earnings level constantly forever, and so it would just be it would be a perpetuity of the same earnings. That's the EPS over R, right? Earnings per share over the interest rate. So that's if there's no opportunities for the firm to improve. So any price over and above what you'd expect from a perpetual stream of earnings is the market valuing growth opportunities the firm has, right? If I'm earning $1 every year and I'm worth $100 and my interest rate is 10%, that means I have $10 worth of earnings and $90 worth of hope, right? Belief in future growing earnings. And so in general, we can solve for NPVGO, net present value of growth opportunities, by subtracting the perpetual stream of earnings from the price. So if I have a $75 stock and a $5 earnings, I would do 75 minus the value of the perpetual stream of earnings, which in this case is 31.25, and get the value of NPVGO, 43.75. So that's how we can find these in general using an accounting-based approach. I really like using earnings over dividends. This is sort of not typical in the academic finance community, because we really like cash because it can't be manipulated. And it's true, earnings can and are often manipulated. But it's a trade-off. So the question is, are we more interested in timeliness of the information or in accuracy? So earnings are inaccurate and timely, and dividends are perfectly accurate and generally not timely. Right? We need a long history of future dividends to estimate the value of the stock, and whereas earnings, we just need a really short history. But they can be wrong, right? Companies restate earnings all the time. So given the trade-off between those two things, in my experience, it's more practical to apply the earnings model with except in cases with mature firms that have a steady dividend policy. So if we're consistently paying a dividend and have been for a while, then the dividend model does really well, because the timeliness issue has now gone away, right? The dividends are what the dividends are. Now we don't have to try to imagine what they'll be 50 years from now, because we have tangible dividends now. But for many stocks that have no dividends, won't for a decade, and may or may not after that, and the company may die or not, right? The dividend model becomes very problematic. Okay, so why don't you go ahead and give an NPVGO problem a try. There's one on the course page. And then we'll come back, we'll look at comparables. Okay, comparables is a valuation approach where we find firms that have similar attributes, typically risk, potentially industry, similar cash flows, and do a valuation of our firm based on the value of another firm. Common multiples that are used to do comparables are price to earnings and enterprise value ratios. So an example of a price to earnings ratio, we've done them already, right, in previous lectures, but if I have a firm in an industry, I can look at other firms in its industry and see if they have similar price to earnings ratios. So let's just imagine that I'm looking at a mining company, and the mining company I'm looking at has a price to earnings ratio of 30, and other mining companies in the same industry have a price to earnings ratio of 10. That's very concerning as an investor, right? If I buy stock in this company, every $30 I invest gets me $1 of earnings, when I could have put $10 in a different company and gotten $1 of earnings. Now, it could be that this company had an unusually low earnings year this year, and they're going to bounce back. Or it also could be that the company has a really exciting growth potential, and the market is paying a premium to capture that growth potential, but in fact have not even paid enough. So maybe 40 is the right number rather than 30, because the growth potential is so great. But that would be that would require a belief in growth opportunities even beyond that of the market, which is already much beyond the rest of the firms in the industry. In the Wall Street Journal, when they calculate price to earnings, they use the last 4 quarters earnings. Then you get a ratio of the price compared to the earnings, and use that as a comparable. So if we think about using our old formula from just a couple slides ago, where the price was composed of an earnings perpetuity plus growth opportunities, if we divide both sides by R, right, then we have, if we divide both sides by earnings per share, then I have price over earnings per share. So that's the PE ratio. So the PE ratio is equal to 1 over the interest rate. All right, so the larger the required return, the lower the PE ratio, all else equal. And the larger NPVGO, right, the larger growth opportunities, the higher the PE ratio. So a firm's PE ratio is positively related to growth opportunities. They get bigger when growth opportunities get bigger. And it's negatively related to risk. It gets smaller when risk is larger. So the PE ratio focuses on equity, but what if we want to value the whole firm? So in particular, we can think about many financial claims. We get the equity claims, the debt claims, and other things. And so an enterprise value is a quantity that's used. Enterprise value is the market value of the equity plus the market value of the debt minus the cash on hand. So the reason to subtract off cash is it's naturally going to increase the value of the firm by exactly the amount of cash, basically. Right? If I have a business where I stand outside of the grocery store for 1 minute on Tuesday and ask people to buy a $10,000 candy bar, right? This is a worthless business that does nothing. But if I have $1,000 in the checking account of that business will be worth $1,000, even though it's essentially worthless. Right? So the value of the enterprise is zero because the value of the cash and the value of the business are the same. So an enterprise value is a way to try to get at that idea. So we take cash out of the equation, leave only the value of the financial claims without the cash, and then we can compare how much is the market valuing this enterprise relative to the cash flow it's generating, right? If the firm is generating lots of cash flow and the market has a very low value, either this is a really good buying opportunity, or the cash flows are likely to decline in the near future, right? So then this is the kind of comparison we could make. If you get a much lower enterprise value ratio than other firms, then this is significant as an investment decision because it makes it look more attractive, all else equal. So we can find the value of a project using NPV, but we can also find the value of an entire firm that way as well. We just find the operating cash flow of the whole firm in each period, and then find the value of the firm itself using the value of its cash flows. And so that's a bottom-up approach where we start with the very fundamentals, the income statements and the earnings themselves, and build up to the value of the firm using its cash flows. And so we can do the same thing with earnings. So you can do cash flows, you can do earnings, either way. For the same reason that dividends and earnings are a choice, right? We have timely and manipulatable versus not timely and not able to be manipulated. So let's look at an example here. So suppose a firm has current cash flow of $225 million and it's expected to grow at 4% per year in perpetuity. Okay, so you can already get a feeling where we're going right away with this. So we have 225 is our year zero cash flow, and it's a perpetuity. So we would do 225 divided by R minus G, so 15 minus 4, except for 225 is year zero, and we need year 1, so we're going to multiply by 1 plus G. So that's that $2.127 billion. So that's our estimate based on a cash flow model. We could do a price to cash flow multiple, or it's similar to a PE ratio. And let's say that the industry typically had a price to cash flow ratio of 9, then that would imply a valuation of $2 billion. So our cash flow model is finding the firm is worth slightly more than the multiples model. And so it might be then, if we're making an investment decision, that we would choose to buy this company because the value of the cash flows we're predicting exceed the value of the firm as described by the market, and so it's I guess another way to get at it is to value the cash flows of the business instead of waiting for those cash flows to be distributed. Right? We don't have to distribute cash as dividends right away. We can hold it. And this is important especially now because firms tend to be accumulating large amounts of cash, especially in overseas subsidiaries. Right? So if I make a bunch of money, I use some transfer pricing, I stow a bunch of cash overseas, and then when a recession hits and the government declares a tax holiday, we bring the money back at lower tax rates and distribute it then. And so the distribution of the cash flow itself has odd timing, whereas the earning of the cash flow itself is more timely. And then accounting earnings themselves would be even more up to date. Okay, so that's all valuation stuff. So where do these values get used? Well, they get used in secondary markets. So more than any other security, common stock have the most active secondary market. We call it a secondary market. Other secondary markets you probably are familiar with would be StubHub and maybe a rummage sale or a garage sale or a yard sale, depending on which part of the country you're from. I think rummage is maybe a Midwestern thing. I haven't heard that too many other places. Right, rummaging through your basement, and basements are probably I am familiar with basements, and you probably are in Philadelphia too. But tell a Californian about a basement, and they may not know what you're talking about. So there are lots of secondary markets where we resell things that are already previously owned by someone else. And that's what stock markets are, right? You can think about the New York Stock Exchange as like a big flea market where people are offering used shares that you can buy from somebody else. So the biggest stock market is the New York Stock Exchange. It has a trading floor, but it also has a very significant electronic trading operation. At this point, the floor trading is to a great degree marketing, right? It's kind of for show. I mean, there's activity that still happens down there, but it wouldn't need to. I mean, I think there's just kind of a preference to keep it around a little bit. If they wanted to, they could shut it down, and it would probably be fine. Although there are larger trades that are negotiated person to person, and so there's some face-to-face that still happens that's important. But then, so the New York Stock Exchange is the largest. Second largest in the United States is NASDAQ. So this is it's an association of securities dealers that have a computer-based quotation system. And they tend to have more technology-based stocks, smaller stocks, although there are plenty of large stocks on NASDAQ. So that's the number one stock market is NYSE. Number two is NASDAQ. Other stock exchanges are BITS Direct Edge. So this is a third exchange started recently, 2005 in Lenexa, Kansas. And these stock markets are technology companies focused on speed of execution. So if you trade on BITS or Direct Edge, you can trade very quickly. They have a lot of volume in the United States, sometimes more than NASDAQ, but typically not. But historically, there were many other exchanges. There was actually a Philadelphia Stock Exchange at one point. There was a San Francisco Stock Exchange that was important. And the Amex was the number 3 stock exchange when I was a child, but it kind of dwindled to be very small and was purchased and folded into the New York Stock Exchange. So there's lots of history around stock exchanges. I met a fellow from Romania in when I taught at the University of Wisconsin La Crosse, and he said that their country before a government change and it was shut down, they had one of the oldest stock markets in Europe. So you don't really think of, you wouldn't necessarily think of Romania as being a financial center of Europe, but at one point that was somewhat true. They had a really early stock exchange, but it did not last. So there's been a lot of consolidation in the sector. When we look at stocks, stock prices change throughout the day. So often when you see a stock quote in a newspaper or on Yahoo, there's a couple key pieces of data that often are included. So here, this is a listing for Gap. The first are the high and low for the year. This helps traders know kind of what's the range of prices they can expect the stock to take if they're trying to mitigate risk a little bit. It has the name and the ticker, so if you've ever seen, it comes from, let's see, this is one of my favorite movies. You have the Hudsucker Proxy. The executive is in his office, and he's got that glass globe that has paper on it, and it spits out stock prices on a little tape, right? And so in order to save paper, they have a small symbol on that historical thing has persisted. So now you see them, right? You have stock tickers as like an electronic light board where prices kind of go by, like, move around the room or something. This is often sort of the visual symbol we identify with stock markets. The dividends are reported in quotes, as well as the dividend yield and the PE ratio. Volume is the number of shares that trade. You could have very large volume days where no trading or no price change happens, and you can have small volume days where lots of price change happens. They aren't necessarily connected in ways that you'd think, but we can speak generally to say that high volume days are maybe days where there is lots of market uncertainty about the price movement and maybe disagreement, right? So let's imagine, and often it indicates information being processed. So let's say there's new information about a company. The market itself will disagree on whether or not this is good news or bad news, or how much. And so if I am a person who believes it's bad news relative to everyone else, I'm going to sell. If I'm a person who believes it's good news relative to everyone else, I'm going to buy. And so that requires a lot of volume to fix. So high volume indicates information processing sometimes. We have a closing price, so that's the price at the end of the day. Stocks have a bid price and an ask price, a price that you can sell and a price that you can buy. The close doesn't indicate whether it closed at the bid or the ask, so we don't necessarily know what kind of transaction that was. That matters because the difference between the two is the commission for the broker who sold the stock. That used to be a big deal, especially, when I was a kid, stocks, the minimum price change for a stock was 12.5 cents. Nowadays, they can change as small as 1 cent. So, and often do, especially for larger stocks. And so the difference between the bid price and the ask price, and nowadays is only a penny, and so it doesn't matter as much. But when it was 12.5 cents, it mattered a lot, whether you had the bid price or the ask price. So yeah, that's a little institutional detail about stock trading. It's kind of it's kind of like the attention-getting drama queen of financial instruments, right? Everybody pays attention to the stock market and talks a lot about it, where the real work gets done in derivatives and government bonds and other sort of boring things. But it's still really interesting to think about the stock market, and actually stock ownership is a big, important segment in a lot of people's retirement planning, and I know it is in mine. So the stock market is really important in finance globally, and so it's good to know a few facts about it. So anyway, thank you, and I'll see you next week.